This is Wall Street Week. I'm David Westin, bringing you stories of capitalism. This week, as the business and political elites gathered in Davos, Switzerland, what did they try to accomplish, and what are the odds of success? Plus, President Trump pledges to deport unlawful immigrants by the hundreds of thousands. We look at what that could mean for the economy. And the rapid growth of non-alcoholic beer. What is driving it, and how far could it go? But we start with the tragedy of the Los Angeles fires, measured first and foremost in the lives lost and the homes destroyed. It's much more than a story about money, but it is also about money. And sadly, only the most recent chapter of a story we brought you in December about how much we are willing to pay to protect what we value. Then it was losses from hurricanes in Florida. Now it's about the even greater losses from fires in Los Angeles.
It's a lot of hard work building a business, and seeing this, it's tough.
And we could see fireballs just rolling up the street.
Really scary when you can see the flames coming up over the houses. It looked like pandemonium.
I'm a retired firefighter, so I know the dangers. When it's a wind-driven fire, there's nothing that, very little we can do.
It's definitely tough. There's a lot of people who don't have insurance.
As those that lost their homes try to figure out how, or even if, they can rebuild, they'll be turning to their insurance companies. JP Morgan estimates the insured damages covered could exceed $20 billion, which would make these the costliest wildfires in U.S. history. So could this push California's insurance market to its limit?
This is speculative and shifting day by day, so we're not sure exactly where it's going to land. But the insurance industry that have looked into this and looked at the impact on their book are not running for the hills.
Jerry Theodoro is director of the Finance, Insurance, and Trade Policy Program at R Street Institute, a DC-based think tank that promotes free markets. Like Theodoro, S&P Global Ratings says the insured losses from the LA fires should be manageable. In part, that's because it's not just the primary insurance companies bearing the losses, it's also the reinsurance companies that back them up.
Estimated insured losses are $20 to $30 billion, and reinsurance is going to take a big piece of that, risk that's spread all over the world. Bermuda, London, continental Europe, the Far East, reinsurance companies taking a piece of the pain. So a big company like the Farmers, which is the second largest insurer in California for homeowners, has got over 100 reinsurers on its reinsurance panel.
As the ones insured, homeowners are the first step in a ladder of risk that starts with individuals or businesses, goes up to insurers, then to reinsurers, and ultimately can hit investors or even taxpayers. With each step, the risk is calculated, changed, repackaged, and spread around. But one thing we know for certain, it never goes away. Instead, it's increased, and with it, the premiums have also been on the rise.
It's a tragic event, and it's one that the insurance industry, I think, is prepared to deal with because of this incredible distribution of risk. I mean, think about having 100 reinsurers on your panel. Lloyd's syndicates, big guys, big reinsurers in continental Europe, Bermuda, the reinsurers there, some U.S. insurance, Korea, China, other countries too that have got reinsurance companies that take a bite out of the apple of a company that is ceding its risk to the reinsurance market. So that it pays up to a certain amount. This is the most that we're prepared to lose.
Swiss Re is a global reinsurance company, and our clients are insurance companies. We partner with insurance companies to protect their balance sheets.
Monica Ningen is CEO of U.S. Property and Casualty Reinsurance at Swiss Re, one of the largest reinsurers in the world.
When it comes to reinsurance rates, there is an impact from climate change, but it's relatively small. The other factors being economic inflation, wage inflation, inflation of construction, plays a big factor, especially in the last few years. We see people moving to areas that are more prone to catastrophes. We also see people moving into forests that are, of course, impacted by wildfires. So there's a big component of it that comes from just people living in places that are more exposed to catastrophes.
With the help of reinsurance, insurers may be able to cover the enormous losses in Los Angeles, but the owners of homes and businesses will pay part of the cost through higher premiums. Across the country, insurance prices have surged over the past 2 years. Since the beginning of 2023, the cost of homeowners insurance nationwide has climbed over 21%, while CPI rose just 5%. The price of some commercial insurance is up nearly 15% over the same period. After 7 of the 12 major companies writing policies in California cut back on their coverage, California recently changed some of its regulations, specifically to let insurers take into account higher rates paid to reinsurers and to use forward-looking models to project losses like those suffered in LA. But as efficient as insurance and reinsurance may be at distributing the risk up and down the chain, the best remedy by far is to avoid or minimize the risk altogether. For a disaster like wildfires, that begins with enhanced firefighting capacity.
The LA County Fire Department was prepared for 1 or 2 major brush fires, but not 4. This is not a normal red flag alert.
Months before the Palisades fire, the LA Fire Department's budget was cut by about $17 million.
Unless that local government's budget has a whole bunch of just reserve, extra cash, it means that to increase some portion of those services or capacities always comes at the expense of something else. Right now we can point at water, we can point at responders, we can point at all kinds of things.
Frank Frevolt is a former fire chief who now leads the Wildland Urban Interface Fire Institute at California Polytechnic State University.
There are limits to the water system that you can expand. It's not just about getting the water someplace. It needs to have a certain amount of pressure, especially in firefighting situations. You have to increase capacity of storage. You have to improve the distribution system, and that is not cheap. You either have to lay additional distribution lines into the infrastructure, which means tearing up roads, going through other utilities, disrupting traffic, or you need to increase the diameter of the things you already have, which is really the same thing.
LA will rise, and make no mistake, I am confident that we will rebuild.
But what will that rebuilding look like? And will it be different in ways that reduce the risk of these sorts of losses being repeated in the future? Risk models flag the Palisades due to several factors, including high home values, challenging terrain, and windy, dry weather.
The more we build out into fire-prone areas, and in California, many of our areas are fire-prone. We have these very flashy climate episodes of really wet, 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 then dry, 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 hot, 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 which means that the vegetation at any given time is very susceptible to burning. And so the more humans are out there at the urban interface with this highly flammable landscape, the more likely there will be an ignition.
Stephanie Pincel is the director of the California Center for Sustainable Communities at UCLA. She points out that city planners don't have as much say in urban planning as one might think.
This is not the first fire. This is one of many, 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 many fires that has occurred. The problem is we have been accustomed to living in a certain way, and so it's very hard for policymakers to resist the desire to rebuild in exactly the same way. Urban planners have very little to do with that, in fact, because if the mayor and the governor and others proclaim that things are going to be rebuilt in exactly the same way in exactly the same places, the urban planner only has to follow they have to follow along. They are not at the leading edge.
Taking steps to reduce future risk will not come cheap, which means that there has to be the political will to spend the money that's needed.
We have to really think practically about what rebuilding can look like. The other thing is that is not talked about very much is we're a tax restricted state, and we need to have a vigorous and serious discussion. We have to do things like public participation budgeting, give people a budget. Where would you spend the budget? Let's have a discussion about this and bring people into the understanding of what governing your place is like, and that these decisions are not easy decisions.
I'm just happy to see the community rallying together. I know everyone's been on the phone texting about how we're going to come back from this, and it's going to take a lot of effort and a lot of time, but I love Pacific Palisades, and I really trust in my home to come back together and rebuild.
But in the end, it all comes back to those experiencing the loss most directly and painfully. It turns on the behavior of those of us at the bottom of the insurance chain to determine whether and how best to protect ourselves from the next one.
So when you look to the future, I think there's a few things that will change. I think that consumers will start to better understand their own risk exposure and what their own resiliency looks like. As events impact our lives every day, consumers are being more aware than they ever have been on the risks that their homes face.
Whatever we do not build back in the same place in the same way, or we have the same consequence.
Coming up, we turn to the snowy slopes of the Alps, where we talk with our special contributor Larry Summers and Afsani Beshlos of Rock Creek about what the move away from globalization means for things like the World Economic Forum. That's next on Wall Street Week. The World Economic Forum was founded in 1971 to bring together leaders from around the world to develop a common agenda on important policy issues. The theme this year is collaboration in an intelligent world. Collaboration is something we aren't seeing all that much of, I must say. We are joined once again now by our very special contributor, Larry Summers of Harvard, who actually has now been coming here for parts of 5 decades. So welcome, Larry. It's great to have you.
Good to be with you here in Davos, David.
So give us your perspective over the years. I mean, it was a very different world in 1971. How has Davos changed or not changed over that period of time?
It's still cold. It's still crowded. People are still networking at a ferocious rate. I think the world saw Davos and the people who came to Davos with a bit more admiration some years ago than today. If you look around the world, the election of President Trump in the United States, what's happened in France with Le Pen, what's happening in Germany, almost everywhere, the kinds of political figures who don't really like Davos and the kind of cosmopolitan globalism for which it stands are riding high. And people here have different reactions. Some are scared, some are angry, some are a little bit contemptuous. I think it's important that everyone be listening and reflecting on the political strains that clearly are more present in democracies today than they were a decade or two ago.
There has been a fair amount of discussion about what the re-election of President Trump means. A lot of discussion as well about generative AI, something that you've been talking about for some time, and the technological innovation that's going on. What do you make of that? And maybe as important, does technology help us avoid financial mistakes?
I don't think technology is any kind of armor against financial excess. I even argue the opposite. I think almost all bubbles start with a story that's based in reality. The internet was a big thing in the 90s, but that didn't stop a bubble from developing in 1999. Japan had really come into its own as a highly productive, rapidly growing economy, but that even contributed to the massive Japanese bubble in the 1980s. the 1920s were a period of extraordinary technological change. It was the biggest period for diffusion of both electricity and the automobile in the United States. But that didn't stop. Indeed, it contributed to the euphoria that led to excesses in the market and to a sharp decline in the market in the 1920s. So I think it's a mistake for people in markets to lose sight of the fact that even if there are happy things happening technologically, that those are not armor against financial or cyclical excess. And I think that's particularly important at a moment when there are lots of questions about the processes generating public policy.
Afsani Beschloss of Rock Creek has been participating in Davos meetings for many years. Although she didn't make it to Switzerland this year, we asked her about how it has adapted to a changing world and what comes next.
First of all, the number of people going has changed a lot, David. This year, I think it will be close to 3,000 people going from 130 countries. It started much more as a European, much smaller focused group for business leaders only. So in that way, it has changed. It has also changed in terms of the scope. It used to really look at a few topics, and now it looks across so many different sectors, from energy to tech to utilities to infrastructure to a lot of the soft and to a lot of issues that are interested to nonprofits only and governments. So the scope of the topics covered has changed. The biggest change I find is that, let's say, if you went there in the early 1990s, as I did, what you would find is that you could cross-collaborate a lot more. By that, I mean, if you were in one sector, let's say finance or economics or multilateral groups, you would be talking to other groups as well. And you would go into meetings that you knew nothing about and come back learning a lot about specific topics. Today, WEF is very, very established. But both advantage and disadvantage is that you go in your own lane. So if you are a business leader, you are meeting with other business leaders. You may go to the morning yoga session with a lot of other people, but really most of your sessions are pretty determined. If you're a university president, you go into meetings with other university presidents.
Obviously, the World Economic Forum has evolved over the many years it's been in existence. The world has changed as well. When it was started back in 1971, most of the multilateral cooperation set up in the wake of World War II was still intact. A lot of it is challenged today, if not absolutely taken apart. How does the world, the way it exists now, really make it possible for WEF to do what it's trying to do?
I think, as you said, the world is a very different place today, and I think what the WEF allows is often actually at the sidelines of WEF for people who are having some sort of conflict to meet and talk in ways that they might not be able to do. So you do see politicians who are meeting there in quiet ways. A lot of business gets done there in also relatively quiet ways. So people looking at M&A or people looking at specific kinds of deals get a lot accomplished during these meetings in a very concentrated way.
Klaus Schwab obviously founded it and continues to lead it. And the agenda for this year, as I understand, is collaboration in an intelligent world. The intelligence, yes, in part, in artificial intelligence. And he's made a call for really having global cooperation in dealing with generative AI. What are the prospects for that?
I think, David, it would be great if there was cooperation globally across the globe on generative AI. But as we both see, that is probably not very likely. If anything, with the existing geopolitical issues that we see, there's more division on how countries and scientists and technical people are developing AI. And if you're sitting in the US or you're sitting in China or other parts of the world, I think people are not necessarily collaborating. Even inside countries, companies are not necessarily collaborating, as we see whether you're looking at OpenAI or other companies that are involved in developing a lot of the new technology. I think there's not necessarily as much collaboration as you would like. But I think the bigger topic, and Klaus does touch on this, is not just collaboration is probably not going to happen as much as he would like in these meetings.
When we think about global cooperation, I am struck at least by the difference between the response to the global financial crisis in 2008, 2009, where to a large degree, I believe nations, even rival nations, came together to fix it, and the response to COVID-19, where it's not at all clear they did come together in 2020. Is that indicating that it's harder and harder to get rival nations to really work with one another?
I think definitely much harder today in terms of the rivalries between nations. But also what has happened is the world economic order has changed. What you had, maybe if you looked even at the stock market, you had, for example, the Chinese stock market had become large and you saw that it was a big share of the market. European markets were a little bit bigger. Today, you have such dominance of the US when it comes to finance, when it comes to the size of the US companies, when it comes to the power of the US dollar. A lot has shifted. While 10 years ago, we might have thought there would be more diversification with the global south, with a lot of emerging markets doing better, with Europe doing better, with the EU. What we have found is that whether it is regulation in the EU, whether the differentiation in emerging markets among them, those who have used technology in a different way compared to the other ones, and where there's been more political strife. And by the way, we should look at the red points. When you look at the WEF new risk areas, the risk of war has increased, particularly in emerging markets. So you have a world much more dominated today by the US in a way you didn't before. So this strife that we see, I think, increasing because of the huge differentiation that you see between the US and other countries. And I think China is going through so much of its own problems, where internal consumption is not going up, where you have the demographic issues, where you have growth issues, where the growth of the economy is coming to much lower levels. So you are in a different world that's not very conducive to cooperation.
If we were creating the equivalent of a World Economic Forum today, would we do it the same way? I wonder, there are so many alternative meetings that are held around the globe pretty much every day of the year, somebody's meeting. And the need for cooperation, global cooperation, has gone up, even as the prospects for it may have gone down. Is this the most effective way to really develop global agendas on these important issues?
I think if you were starting from scratch, you might do it differently. You might, again, go back a little bit to the origins of WEF and truly try to get groups that do not necessarily come across each other or talk to each other to start talking much more across and sort of take out the hierarchy out of it a little bit. So in that way, I think things could be done differently today, and also bring young people into the conversation much more. Because at the same time as WEF has accomplished bringing a lot of different kinds of people, it is still fairly regimented when it comes to different populations. I think you would do it differently. One thing, David, that was very interesting with COVID is when COVID happened, I think a lot of people thought that WEF would die potentially. But what we learned is that people, as much as we like to meet on Zoom and as much as we like to meet more efficiently, electronically and digitally, we really want to meet each other in person. So you certainly need people to come together in person to discuss big topics and come to some sort of resolution.
Coming up, non-alcoholic beer is all the rage, at least for some. We take a look at the fastest growing non-alcoholic brand in the United States, Athletic. That's next on Wall Street Week. This is a story about habits, those we love and those we should probably do something about.
Saw the barrels of beer and thought, oh, we'll have one of those.
I love beer, so here's the right place to be.
Alcohol has been part of human society since the first beers appeared in the Stone Age. It spans everything from pop culture.
Go to the Winchester, have a nice cold pint, and wait for all this to blow over.
To presidents. But now, after thousands of years, change may be coming to the $1.6 trillion alcohol industry.
We used to have a phrase in the early days, people drink in good times and people drink in bad times. Well, the trends appear to be disproving that.
Brad Berkman's family has been in the alcohol business since his great-grandmother became one of the first women to hold a New York State liquor license. Now he's a lawyer at Green Spoon Marder, representing breweries, wineries, and distilleries.
There's a lot of concern with sales volume. 2024, as we move into 2025, we've seen significant drops in all categories of alcoholic beverages. That is wine, beer, and distilled spirits. And the industry is a bit rattled by it.
And it's young people driving the change. In a survey last year, IWSR found that the number of U.S. drinkers who had added non-alcoholic beverages to their mix had gone up from 7% to 13%. For millennials, it was 22%, with Gen Z following at 15%.
I mean, boomers are still drinking, right? We're not seeing that much of a difference in all categories. But Gen Zs, as I mentioned, are looking for health alternatives, or healthier alternatives, at least those things they perceive to be healthier. So, what does that mean? It could mean non-alcoholic alternatives. It could mean low-proof drinks, low-proof spirits. It could mean seltzers or similar products.
While bar and restaurant volume is an overall low percentage of our volume, I think it's a really high introduction to our product.
One of those making the change from alcoholic to non-alcoholic beers was a young trader at Point 72 named Bill Schufelt.
I was turning 30, taking my career more seriously. I was about to get married and kind of evaluating all these major goals in my life, like health, wellness, relationships, career, being a father. And there was one thing that was a ceiling on all those things, and that was alcohol. And I kind of realized, I'm going out to 3 or 4 work dinners a week, then social things, dinner with my wife, and relaxing on weekends. And I went from someone who was surviving workouts to loving working out. And so basically feeling the best I'd ever felt and being as productive as ever. But I was still at all those social things. And I realized there was no other half of the adult beverage menu. So if you wanted to be in all those places and not drink, there weren't options.
So Schufelt teamed with craft brewer John Walker to create some of those non-alcoholic options, founding Athletic Brewing in 2017. Today, the Connecticut-based brewery is rapidly approaching a $1 billion valuation, riding a surge in non-alcoholic beers since 2018. The category now accounts for 1.5% of total beer sales in America.
Most food and beverage businesses outsource production, at least in the early days. We made the opposite quality decision to do everything ourselves. And so our first brewery we built, it took me 120 investor meetings to raise our nearly $3 million from 66 incredible angel investors. And we thought we were building this brewery for 5 years, and it was oversized, enough cushion there. And we outgrew that brewery in 10 months. And so immediately we're going back to our investors and seeking a bigger plan. And so our next brewery was 3,000 miles away in San Diego. It was about 10 times the footprint and about 20 times the output of the original plan. So the first one we built in Connecticut was the first ever non-alcoholic production facility in the US. And then immediately we built one 2 years later, 10 times the size of that. And then the year later, we started building another one on the East Coast that was 2.5 times the size of that bigger one, and about 50 times the size of our original brewery.
As you look to continue to grow your business, what's the lowest hanging fruit? Is it to get other areas that you reach geographically? Is it to get more people drinking the category? Is it to move into other beverages?
I'd say most of all of the above. I'd say nationally our awareness is still pretty low. Only about 20% of Americans even know the non-alcoholic category has been totally revamped and is a really exciting place. So I think new consumers becoming aware of the category. In the independent on and off premise, so privately owned stores, our penetration is still pretty low also. It's below 20% nationally, so there's a lot of opportunity to be more available. It's a really under-distributed category, despite it being the fastest growing category in beer the last 5 years. So I think new populations, awareness, distribution are all probably the biggest opportunities.
It may be small, but it's growing fast, and Schufelt thinks that growth has a way to go.
I really believe that first 0 to 2% is the hardest, like getting the boulder rolling. I think 2 to 10% is going to be incredibly faster than people think, and 10 to 20% will happen in a blink. And I think it's probably going far beyond that also, which that would point to a category that's somewhere in the $25 to $50 billion range in the not too distant future.
Reaching those numbers would require the sort of generational culture shift that Shufelt feels is beginning to take hold in corporate America.
I kind of saw in my financial career over the 12 years I was in finance, it went from being a badge of honor to be hungover and out entertaining to really frowned upon. And people were really performance driven and health driven. And so I saw that change in myself. And so I was definitely extrapolating that there's this big tipping point coming in society, which has actually played out over the last 10 years.
When you talk about tipping points for alcohol, you have to give credit to Dame Inga Beale, who, in 2017, when she was the first female CEO of Lloyd's of London, instituted a ban on employees having alcohol between the hours of 9 and 5, part of a broader initiative to modernize an institution established over 3 centuries ago.
I started working in the 80s, and I can remember going to the bar, going down the pub with the other underwriters, with my co-workers, with the brokers who brought us the business, and necking down a few glasses of beer. So I remember growing up like that, but times had moved on, and I said, look, we need to make sure that we've got people sober when they're making big multi-billion decisions sometimes. So we said, right, we're going to have a drug and alcohol policy, which means you won't be able to consume alcohol if you're coming back to work during the day. So if you're in working hours, no alcohol. Wow. I had no idea that that would get me more headlines than anything else I did while I was modernizing Lloyd's. The technology I was doing, introducing the innovation lab, opening up new markets. This was the one, this banning alcohol at lunchtime, that got me more headlines around the world. I wasn't expecting it, so there was this huge backlash. And when you're going through any change and you haven't really involved and included people enough, you can always have backlash. If you're ahead of your time, you're trying to force something through, particularly when it's unexpected. I mean, nobody likes to be perhaps told what to do. So I was accused of operating a nanny state, so fundamentally trying to control everything that everyone was doing. So that was very much a backlash on me personally. And people didn't really understand why it was necessary, because they'd been used to it for so long. They'd been used to it for centuries, actually. When you're doing culture change, even though culture is so difficult to define and so difficult to actually explain and tell somebody else about, we are talking about a real culture change here.
Even with some initial backlash, Beale's policy shift did stick, and Lloyd's has since widened the policy to include anyone entering its offices.
If you go to the bars around the Lloyd's market now, you'll see a whole host of array of non-alcoholic drinks for sale. And I remember when I used to be a young underwriter, you'd go into the pub, the bar, the beer was the cheapest thing. If you wanted the equivalent volume in a soft drink, a soft beverage, it cost much more than the beer did. It just wasn't the done thing. You're seeing we are feeling now in the London market, the financial market, a difference. And non-alcoholic beverages now are basically not being priced out of the market like they used to be.
And while that culture shift is opening up a market for the likes of athletic, the ultimate question is, how far can this trend go? Could the future of alcohol be under threat? Could alcohol go the way of cigarettes, something seen as ubiquitous a century ago, but now a rarity on Wall Street or the City of London?
I don't think it's a flash in the pan, but will it go, the way of the cigarette and tobacco? I don't have an answer to that yet. I strongly doubt it, only because the cultural aspect and society, if you will, of the consumption of alcohol, right? And how we drink and where we drink and all those events that are tied in to the consumption of alcohol. And frankly, all businesses that are tied in, or other businesses that are tied into the consumption of alcohol, bars, restaurants, hotels, you name it. There are too many opportunities. It's too baked into our culture. It's too baked into many people's lifestyles to go the way of tobacco. That doesn't mean that we're not going to see a decrease in consumption as a result of these health concerns. I predict that it will have some effect. We will see a decrease in some sales of alcoholic beverages, particularly those that are perceived as being unhealthy. Popular priced products may take a hit.
If I'm a traditional alcoholic beer producer, should I be worried about you? Are you taking away market share from me?
So I think we have some parallels to other industries like plant-based meat, plant-based milk. But the big difference is, like, athletics not trying to bring back prohibition. We're not trying to take away anyone's alcohol. I was just a consumer who was at bars. I love beer. I love good food. I wanted to be in those places, and there was nothing on the menu. And I think there are 50+% of adults in that position. Alcohol and beer have been around for 5,000 years. I don't think it's going away, and it's a big part of society and social traditions. However, there's this really exciting growth vector of the category that I think shouldn't be ignored. It should be embraced and encouraged and fostered. But we're definitely not trying to be antagonistic to the industry. We're trying to help it grow.
The U.S. produces about 175 million barrels of beer each year. It seems unlikely Americans will lose their taste for beer anytime soon, but they just might revisit their taste for alcohol. Cheers.
Cheers.
Thanks.
Thank you.
That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. Join us next week for more stories of capitalism.